Let's be honest, most people think bonds are boring. When you hear the word bonds, do you picture slow, sleepy returns and complicated jargon? Or maybe you've heard that bonds are only for retirees or people who already have a mountain of cash. But what if I told you there's a simple, low-cost way to tap into the power of bonds? One that's as easy as buying a stock and can help you build real, steady income? That's what we're diving into today, Singapore Bond ETFs. Here's the thing. With Singapore T-bill yields drifting lower this year, many investors are feeling stuck. Stocks can be wild. Cash is losing ground to inflation, and individual bonds seem out of reach. But what if you could get a basket of bonds diversified across governments and companies with just one trade? What if you could earn passive income every quarter or half year and do it all from your phone? That's the magic of bond ETFs. They're not just for the ultra-rich or finance pros. They're for anyone who wants to put their money to work, grow their wealth, and sleep well at night. Today, I'll show you exactly how to pick the right Singapore Bond ETF for your goals, whether you want maximum safety, higher yield, or even exposure to China's bond market. Stick around, because I'll break down the pros and cons, show you the top ETFs on the SGX right now, and give you practical tips you can use today. Plus, I'll share examples to help you match the right ETF to your risk level and income needs. If you want to dive even deeper and get exclusive investing insights delivered every single day, you can become a premium member for just $1 a month. You'll unlock a wealth of extra content like daily market analysis, early insights into promising trends, and deeper dives into strategies that can give you a real edge. Think of it as your daily dose of financial fuel. I'll share more on how to join after the intro. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering stocks, finance, CPF, and all things wealth growth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 850,000 reads and 53,000 likes. I've produced over 800 videos with more than 350,000 watch hours as of February 2025. I also focus on regional and global economic trends. So let's jump in and make bonds work for you. Let's start simple. Imagine a basket filled with eggs. Each egg is a bond from a different government or company. Instead of betting on one egg, you get the whole basket. If one cracks, you still have plenty left. That's diversification, and it's the core idea behind bond ETFs. A bond ETF is a fund that holds many bonds. It's listed on the SGX, so you can buy and sell it just like a stock. You don't need a huge sum of money or a special account. You get instant access to a mix of bonds, government, corporate, even foreign, without the hassle. Here's why this matters now. T-bill yields have dropped. Stocks are up and down. Cash is losing value to inflation. Bond ETFs give you a steady, passive income stream. As of May 2025, Singapore Bond ETFs manage over 3 billion Singapore dollars and offer dividend yields from 2.31% to 7.59%. That's real money working for you. Many people think bonds are slow or too complex. Some believe you need to pick individual bonds or build a ladder of maturities. But with bond ETFs, you skip all that. You get professional management, broad diversification, and easy access all in one trade. Let's talk about the advantages. First, diversification. You own a mix of bonds from different issuers and with different maturity dates, which spreads your risk. Second, easy access. You can buy and sell with a click, with no need for big capital or complex strategies. Third, regular income. Many pay dividends every quarter or half year, so you get a steady stream of cash. Fourth, liquidity. You can trade them anytime the market is open, just like a stock. Finally, low cost. Most charge between 0.20 and 0.50% per year, which is much lower than many mutual funds. Of course, there are some disadvantages. Unlike a single bond, ETFs don't have a set date when you get your money back. The price can move up or down. If interest rates rise, bond prices fall. If you sell during a rate hike, you might take a loss. And higher yields often mean lower credit ratings, so there's more risk. Let's look at the main players on the SGX. As of May 2025, the ABF Singapore Bond Index Fund has over 1 billion Singapore dollars in assets and a yield of 2.31%. It's rated AAA and pays dividends twice a year. The Nikko AM SGD investment grade corporate bond ETF has 620 million in assets and a yield of 3.27%, rated A with semi-annual payouts. The iShares JP Morgan USD Asia Credit Bond ETF offers a yield of 4.23% and pays quarterly. The iShares USD Asia High Yield Bond ETF is the highest yielding at 7.59%, but it comes with higher risk and pays out quarterly. There are also China-focused options like the ICBC CSOP Chinese Government Bond Index ETF and the Nikko AM ICBCSG China Bond ETF, both with yields around 3% and semi-annual payouts. How do you choose the right bond ETF? Start with credit rating. If you want maximum safety, go for triple A-rated funds like the ABF Singapore Bond Index Fund. If you want a balance between safety and yield, consider A-rated funds or those focused on China. If you're chasing higher yields and are comfortable with risk, look at high-yield options. Next, consider the dividend yield and how often payouts happen. If you want the highest yield, the iShares USD Asia High Yield Bond ETF is your pick, but expect more ups and downs. If you need regular income, look for quarterly payouts. Also, check the expense ratio. Lower is better, and most Singapore Bond ETFs keep fees between 0.20 and 0.50% a year. Don't forget to look at the track record. For example, the ABF Singapore Bond Index Fund delivered a 5.78% return over the past year, while the iShares USD Asia High Yield Bond ETF was down 2.25%. Past performance isn't everything, but it helps set your expectations. Let's match some examples to different investor types. If you're safety first, stick with government bond ETFs. If you're a yield hunter, the high yield options might suit you, but be ready for more price swings. If you want exposure to China, explore the China-focused ETFs. And if you love regular income, go for funds with quarterly payouts. Here are some practical takeaways. Match your risk appetite to the right ETF. Check how often you'll get paid. Keep an eye on fees, because lower costs mean more money in your pocket. Don't put all your eggs in one basket. Mix government and corporate bond ETFs for better balance. And remember, yields and returns change, so review your picks at least once a year. Let's wrap up with the key points. Singapore Bond ETFs are a simple, low-cost way to get steady income and diversify your portfolio. They're easy to buy, easy to sell, and give you access to a wide range of bonds with just one trade. Whether you want safety, higher yield, or exposure to different markets, there's an ETF for you. If you found this video helpful, hit like, subscribe, and share your thoughts in the comments. Your support helps this channel grow and reach more people who want to take control of their financial future. If you want to level up your investing game with daily premium insights for just $1 a month, click the link in the description below to become a member. You won't regret having that consistent stream of valuable information that can help you on your financial journey. For your next step, check out my video on how to build a recession-proof portfolio in Singapore. It's packed with practical tips you can use right now. Thanks for watching, and I'll see you in the next one.